Hey, before we get started, I wanted to remind you we're ending our quarterly theme of taxes soon, and you just have a few remaining weeks to download the 10 important things to know about taxes on our website. You can get this white paper by going to wiserinvestor.com, enter your email at the very bottom of the page, and you'll get immediate access to 10 important things to know about taxes. Basically, this white paper is a summary of everything we've covered this quarter on these various topics with myself and Jordan and our guests throughout the quarter. We're looking forward to launching a new series starting at the beginning of 2022, and thanks for listening. Welcome to the Wiser Wealth Management Roundtable. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today are my two guests, Tom Townsend. Hi, Tom.
Hey, Casey. Thanks for having me.
And Jordan Sute.
Hi, Casey.
Who's a regular now.
Yep.
And not even a guest anymore.
Not a guest.
I think that's your microphone, actually.
I think every week, yeah. For 12 weeks now. Yep.
Oh, now I'm jealous.
Well, Tom, you can come here as much as you want. When we're gonna hear the Tom Townsend podcast?
You know, that is on our 2022 list.
Okay.
Of getting that.
Tom has been on. This is your third appearance, I think. You're the only person ever to be here more than twice.
Oh, okay. Awesome.
So, Hadley will give you a badge on the way out.
Oh, that's awesome. Yeah.
We'll put you a star on the star chart. So, Tom, tell us about your firm.
We have a real estate firm, part of the Keller Williams organization. We're out of Cherokee County. However, we work in primarily everywhere north of the Atlanta area. So residential is our primary focus. We do a little bit of commercial, but primarily residential. So anybody looking to buy, sell, or invest in real estate, we are there ready to go. We have a team there's 5 of us total, and we are growing.
You are growing. I've seen that on Facebook. Yeah. A lot of new team members.
Absolutely. Yeah. We're capturing this market. There's a lot of needs out there that we are fulfilling.
So Tom did appraisals. You did appraisals for many, many years.
Still am an appraiser.
Are you still doing active appraising?
I'm not. I just use those skills and leverage those for our buying and selling clients.
So you started, you were at Wiser Wealth Management before I was.
Yes.
So a lot of people don't know that, but so I had my own firm starting in 2001 through 2007. I leased a spare office from a company called Wiser Financial Services, which is no longer in existence because I bought it in 2007. Nice. And so Tom and his family were already here, and he was mainly doing appraisals, and the financial crisis hit. Mm-hmm. You went through some personal challenges during that time period, but man, you came out on the other side through perseverance and hard work. I
could tell you some stories, my friend. Holy smokes. You bet. Those were tough years.
Yeah.
2008 through about 2013, 14. That was tough. I mean, I went through it and you were right there with me, helping me along that whole way. But that was some challenging years.
Well, you are a testament to, if you keep working hard, at no point did I feel like you were ever the victim. You were always continuing to say, I'm going to fight through this. Now, we all have our weak moments, right? And I'm sure I only saw the best of you, but but I that's what I love about you is you get the job done. And this is not the Tom Townsend show. That I didn't mean to do all this, Tom, but I just want to say I'm proud of you because I see what you're doing out there on social media. I see your numbers as your financial advisor, and you're doing great. We refer people to you.
Yep.
For buys and sells, especially north of the office for sure. But yeah, I mean, if there's anybody out there, it's hard to imagine people out there struggling right now in this environment.
Yeah.
But I know there are because not every industry is prosperous right now. But you just keep pushing through. You don't make excuses. You work harder than the problems working you, and you can come out the other side in great form. So. With that being said, let's transition to the topic of today, 1031 exchanges. So 1031 exchanges, I want to start with a problem and how a 1031 could help solve this problem. So let's assume that I have a $500,000, that's today's value, rental home that I only paid $200,000 for. That sounds like a crazy example, but that's reality right now. Man, real estate's hot.
Yes, absolutely.
I mean, I've seen valuations for beach condos bought in the late 90s for $250,000 going for $1.6 million. And that's a long stretch. Right. But you're telling me you've seen properties jump up in value just in what, a year?
Oh, yeah. Yeah. I
mean, this last 15%?
Yeah. 15, a lot of areas. We have little pockets here and there within the north part of Atlanta, even up to 20%, depending on your price point or where you're at. But yeah, 20% in a year.
That's crazy.
That's crazy.
I mean, that's basically home values keeping up with the S&P 500. Over the last 12 months, S&P is up a little north of 22%. That's not normal.
Can I put a little asterisk next to that?
Yeah, sure.
Because I lived through the crash.
Right.
You got to remember, on average, if you look at home appreciations over the last 40, 50 years, the average is about 4% a year.
Yeah.
When 08 hit, we took a major dip. And it has taken this much time to climb back out of that hole. So if you really look at this on a graph, we are right where we should have been or should be without that big dip in 08 through 12.
That's why we brought you here, Tom.
That's right.
Yeah.
So although it seems crazy and everybody's like, this isn't sustainable or anything, I'm like, we are right where we should be on that trend line. If you look at that trend line over 30, 40 years, we're right where we should be. Actually, we're a little bit higher.
So what you're saying is, if I'm looking at the chart, if I was a technician, that basically we're near where we're supposed to be, and that home values probably won't drop much more. But they could it will seem like they plateaued. Maybe
pull back. We're going to see a little pullback because we're a little bit higher than that trend line right now. So you'll probably see a little pullback.
But no like great deals unless we have a major recession. Obviously,
correct.
There's no one's predicting that at this point.
No.
Interesting. So. I have $250,000 in. What?
Well, we just kind of got a little rabbit hole there, but I
that's a great rabbit hole. I didn't.
Yeah.
I love data. I'm a data guy.
Right.
Yeah. I mean, I got Brad here in my office every Monday morning. He puts all this data right in front of us, and I'm looking through every little nook and cranny to understand what's happening in the world, and the rest. The rest of our crew here is like has sleep at the wheel. It's like, come on, guys, this is good stuff. Okay, so we paid $250. It's worth $500. It's a great little house, but I'm ready to move to something maybe a little more stable, meaning bigger and maybe different type of revenue. So I like to move to a commercial property, maybe a small little strip mall or something. It's got a mechanic in it. It's recession proof, right?
Right.
It's a mechanic and a pawn shop. So I can handle recessions really well if one ever to pop up, because those places do well in recessions.
Yeah.
So I've got this going, but man, Jordan, I'm going to sell this thing and I'm going to have a $250,000. Or how much did I pay for it? I forgot. 200. I paid $250. It's worth $500. I have a $250,000 gain. I got to pay capital gains on that.
Yep.
And at my level, that's going to be 20%.
Right. And I'm glad you're coming to us before you've sold this property.
Ooh, I like what you did there.
Because you have to think about it. Even before you go under contract, really, you should be thinking, is this an option for me moving forward to help defer the gain? You're not going to escape the tax. Well, we can talk about maybe one way that you can escape the tax. But the goal here is to defer the tax. Okay. So you're not escaping, you're just deferring. But yeah, so if you come to us, your CPA, and you're like, hey, I'm going to sell this property, I'm going to have all this gain, we're going to tell you should think about a 1031 exchange. So especially if you're trying to stay in the business of investing and rental and whatever you're working on, it's a great option to take what you have and turn it into something bigger. You don't have to turn it into something bigger, but you're going to pay tax on whatever the difference is there. But the biggest bang for your buck is to take this cash and roll it into an even bigger property to help defer that gain and grow your wealth for sure.
So if I want to sell my property and I change my mind and I'm just going to put it all in the S&P 500 because that's been doing pretty good too, that doesn't help me with that.
No, not with the tax deferral.
Yeah. So it has to be property.
Right. Yes. It has to be like kind property. Yes. So, and when we say like kind, we're talking about the nature of your investment. So you can't take your primary residence and sell it. And if you have over the $500,000 personal home exclusion, you can't take that and roll it into a strip mall and exclude that gain from tax. It has to be an investment to an investment. And it can't be, if you have inventory, you can't roll inventory into an investment. It has to be purely investment to investment.
Okay. All right. So I'll go back to my strip mall, and I got my mechanic and my pawn shop, and I'm real excited about this. So what are the steps? What's my first step in a 1031 exchange? You already told me don't call you after the fact.
Yeah, before.
Right.
So you're going to talk to somebody who knows what they're talking about. So maybe your CPA, maybe your financial advisor, your realtor as well. And they're going to tell you that you're going to have to, there's a very formal process to go through here, because if you receive any of the cash, it automatically that becomes part of your taxable gain. So while under contract, you're going to talk to a qualified intermediary who's going to set it up where instead of at the closing table you get the cash, they're going to get the cash instead. And then from that day that you close, you have 45 days to identify properties that you will roll this gain into. And when they say identify properties, it can be as easy as just identifying addresses of, 3 properties is the typical number that you could roll some or all of the proceeds into.
So who's this intermediary? Is it you?
It can't be your personal CPA. So your qualified intermediary it can't be your employee, it can't be a family member, and it can't be what they call an agent. And so that would be your attorney, your CPA, your financial advisor. It has to be somebody who is removed from the situation and will truly hold the cash for you in an ethical way.
So there's companies that do this.
Yeah. Oh, yes, for sure. So when people come to us and they say, I'm thinking about 1031, we have contacts that we can forward them to who specialize in this, who know the very fine nuanced rules and can help make sure that this passes the IRS's test.
So if you just sold your property and you decide this is what you want to do, it's probably too late to set up any of that. There's no way you could do that.
Right. It's too late. Yeah.
So really you need to identify this and who the intermediary is before.
Correct. Because you've now received those funds.
Oh, right. At closing.
Yeah.
All
True.
right. They cannot touch your personal account.
So I wonder how many days before closing you could get something set up. I'm a last minute kind of guy.
I'm sure there are people that would work with you,
Pretty
probably for
quickly.
a fee, but yeah.
Yeah.
I'm
Ideally, you want to know that you're doing this, find an intermediary and say, I'm about to make this transaction.
Yeah.
What are your processes?
Right. If you have an investment property, I would just keep this in the back of your mind. Even if you're not thinking to sell, just know that it's there and explore it before you're even thinking about selling the property.
Okay.
And then to further the finalization of the 1031, you have 45 days to identify the property and you have 180 days after closing to purchase that property. So you have a good bit of time to really finalize the process.
And those clocks start at the same time, correct?
Yes, correct. Yes.
And that clock starts
at closing.
At closing of your existing property.
Correct.
Okay.
Yes. Mm-hmm.
Yeah. So it's not 45 plus 180. It's really 180. But you got to be at closing, or you have to identify a property within 45 days of the 180 days.
And in today's world, I mean, that could be kind of difficult because you identify a property, it's not going to be there in 6 months. I mean, with the way things are moving right now.
What I'm reading about the process now is people will pick like 3 properties. Mm-hmm. So they'll come to the intermediary with 3 properties, and then hopefully one of those works out.
Right.
Or 2.
Yeah.
You can invest in multiple properties.
Okay.
With your gains.
Okay. So if I get a really good deal on that pawn shop and mechanic strip mall, then maybe I could.
Yeah. Or take the gains off of your one investment property that you sold and go buy 2.
Right.
So now I got 2 revenue streams.
Probably less likely in today's values.
Well, depends on how much you
Unless
have.
you're moving down market.
You can do that. I mean, the point is that you can do that.
Yeah. Okay.
And I think you can even buy into multiple, like a apartment complex. Is that true? So if I sold a single family residence,
rental property,
and then I turn around and I can invest in like an apartment complex.
Yes, absolutely.
Okay. Yeah. Because that's the same asset class.
Right, yes.
And that's what the like kind is all about.
Right. And it's just getting down to the nature of what you're doing. You're investing in this for a revenue stream, a passive revenue stream. Mm-hmm. And so it's similar enough that they both qualify for like kind. Yes. Okay. There really is no definition. That's like the hard thing here. Like kind it's kind of vague. It's very nuanced, but at the same time very vague. So that's why getting together with a 1031 expert is crucial to make sure that you're keeping up with all the rules.
Yeah.
Okay. Something else, I just thought about this. Most people are depreciating their property. So when you sell, a property, not only do you have the gains, but you have to recapture all the depreciation.
Correct.
All that depreciation is going to roll into the new property as well.
That I believe that's part of the gains.
Yes. Yeah.
Okay. So so
it's not just
that's a huge advantage.
Yeah, it's just not. It's
Yeah.
not the simple math of I bought
Yeah.
it for this, I sold it for this, and then take the difference.
Right.
I mean, you've
So
got recapture,
Right.
and then you've got some expenses that you can deduct out of that. I'm assuming.
Yes. So
Okay.
there are closing costs that can be taken out of the proceeds as well. So, I mean, if you, in our example, we had $250,000 of gain and you roll it into another property, say that the way it's all set up, you may be getting some cash back. You can eat into some of that cash with closing cost. Not every cost at the closing table is eligible to roll into it, but some of them are.
So I'm looking at some special rules around this, and so I just want to point this out, that the depreciation and recapture, so which is taxed as ordinary income. We all know this. If you have an improved property, I mean, you have land with something on it, a building that you've depreciated, but then you 1031 exchange that to raw land with no building, then the IRS does not allow you to take that depreciation and roll it into the new property. That depreciation, you would pay income tax on that.
Oh.
So you want to make sure that you're moving from improved property to improved property. That doesn't mean remodeled. That just means improved means it's like Monopoly.
Yeah.
You put a house on Park Place, right? So you can't, if you're depreciating that house on Park Place and you go back and buy Boardwalk, right?
With no improvements on
with
it.
no improvements on it, you can't swap that out and then roll that into the property. So
Right.
I do want to make that sure we're all on the same page there.
And that could be really hard. I mean, if you're not getting any cash out and then you have this bill,
Right.
that would
Yes.
not be
Yeah.
That wouldn't be a good situation.
worst case scenario.
Jordan, do
No.
you think that's because it's a different asset class? Do you think raw land is a different asset class than?
Absolutely. Yes. And so they don't want you taking, the depreciation from the real property for sure.
Yeah. Okay.
So, what are things that we can't do this with? Because, before December of 2017, when we had the Tax Cuts and Jobs Act, which I'm sure everyone here calls this TCGA, I'm saying that with lots of sarcasm. You could actually do this with airplanes, franchises, and other equipment, but you can't do that anymore.
You can do some personal property,
Okay.
but yes, you cannot do stock in trade. So that's like inventory, partnership, shares, notes, stock, bonds, things of that nature are not eligible for 1031. And I do think we should talk about the dealer aspect of it, because you see a lot of people now, they're getting into the business of flipping homes.
Mm-hmm.
They buy it, they flip it, they sell it. In that case, those are not going to qualify for 1031 because the IRS is going to say, no, you're not investing. You're in the business of flipping homes. That should be a business in itself. And so that does not qualify. So if you are flipping, I would maybe add in a rental aspect to it, at least for a period of time, to qualify for the like kind, because otherwise there is a chance that the IRS could come in and say no good, and it all becomes taxable.
So it was probably the initial intent of purchasing the
Yes,
property.
absolutely.
They'll probably
Yeah.
look at that.
Yes, correct.
Yeah. Okay. And my intent was to hold it as an investment property. Oh, it just so happens that I got a great deal and I
Right.
decided to flip it because circumstances changed. But my initial intent
Yes,
was
yeah.
to hold it.
Mm-hmm. Yeah,
And if I do that often enough, they're going to come back and say, okay,
Right.
stop playing games.
exactly.
We're
Yeah.
not going to do this.
Right.
Okay. Yeah.
So what I didn't tell you is I have a $150,000 mortgage on my property that I was selling. And so I've got I'm moving into a new property. What are the rules on the mortgage? And maybe we need to make this simpler for an explanation. But if I'm taking a mortgage, let's say, let's use round numbers. So we have $1 million mortgage on the old property. A new property, after all settles, has a $900,000 mortgage. That $100,000, I actually gained $100,000 because there's less of a mortgage, right? So that gets taxed as income
Yes, any of the cash that's
or
coming,
capital gains.
right? Any of the cash that's coming out to you because you assumed lesser of a mortgage, that is going to be subject to the capital gains tax.
But you could take less of a mortgage, but you're buying a property of higher or same value, and you should be okay, I would think.
If you're putting a larger down
Yes.
payment.
Yeah. If you're adding money to
Right.
that,
Right.
yeah. So you can't use a mortgage to like disguise
Right.
profits, really.
Correct. Yes.
Yeah,
Any cash that comes out.
I would have to check, and Jordan, you may know this, but I think the trade has to be of equal or greater value.
To completely defer the tax, yes.
Okay.
It can be less. You're going to run the risk of paying tax, and the whole thing about the 1031 is deferring as much tax as possible.
Okay.
So you can, if you have, in our example, a $500,000 house, $250,000 gain. Say you want a $400,000 house, and you're going to put $100,000 down. You're getting cash at the end of the day, and so that portion is going to be subject to capital gains tax.
Okay.
We're getting to the advanced portion of this conversation.
Sorry.
Just as a warning, let's talk a little bit about second homes. So I have a home. I've always wanted to have a home down in Hilton Head. Thought that'd be great place to have a home. A lot of people from Ohio there, though. They're nice people, but they don't talk like us. So if I want to go down to Hilton Head, and let's say I already own a home there. It's $8 million. It's on the beach. It's in Sea Pines.
Nice.
Yeah, it's great. It's a virtual one, but it's a great one. And I've decided, you know what? I don't want to be here anymore. I want to move over to, was it 30A? Is that where all the cool people go?
Yeah.
It's a nice beach.
Let's go down to 30A, which is that's not an actual place. That's a road.
The highway, yeah.
It's a highway, but there's other communities along
Seaside. You want to move to
Seaside. I want to move to
yeah.
Seaside. Thank you. I should visit there sometime. I want to go down to Seaside and buy an $8 million house there. But I only paid $2 million for this one in Hilton Head. But remember, I'm not renting this out. This is a second home. I'll have to take a capital gain on that to move it, right?
Yes.
So here's a 1031 strategy. So you could put it into a rental, the second home into a rental program for what, 6 months, some time period.
Yeah.
Not like a week. I rented out for
Right.
a week. But you could claim it as a rental property now,
Right.
right? You literally rent it out. Like this is not a fake thing. It's not a rental property. You're not going there. It's a maybe not long term. It could be vacation rental. Might be better to get more cash flow that way. Then I could do a 1031 exchange, take my gains, and I could buy a property over on 30A Seaside. I've been told.
Yes.
Now, I have to keep renting it out. If I ever
Correct.
stop
Yes.
renting it out,
Right.
Yes.
then I got a problem. But you can still go to your rental property and vacation there yourself. I mean, that's allowed. So that's a great way
It is.
to avoid some tax.
Right. And then you have the option too. I mean, if you roll the funds from there into, and I know that was a big difference in value. I think you said $2 million to $8 million or something like that. But if it was, say it was a $2 million to $2 million or $2 million to $3 million home just on a different beach.
No, I paid $2 million and it's worth $8 million.
Oh,
so
okay.
it's a $6 million gain.
Oh, I see.
Nobody wants to pay capital
So you're
gains
moving
tax
from
on that.
an 8 to an 8.
Yeah, 8 to an 8.
So you roll that cash into the second vacation home and you let it sit for a few years. Maybe then you do a cash out refi and then you get your cash out, So that's an option. You just have to make sure that all of your intent was correct from the first place and you give it some time before you try to do something like that.
Okay. And you could even do that in your primary home. I mean, we said, you can't use a primary home, but if you moved out of your primary home and you rented it out, right? Or no, let's go back a second. What if I moved to Seaside? I rented it out for a while. I moved to Seaside and made it my permanent residence. But then I would get $500,000.
Correct.
I could take exemption of $500,000 from gains.
Right. And there is a specific rule about that one. So if you moved into the home that was previously rental in Seaside, you have to be there for 5 years from the time you purchased it to then qualify. It's a little different from the normal rules for the primary home exclusion, but you have 5 years from the day of purchase for it then to back off from the 1031 rules, and then it becomes the gain is excluded.
Okay.
Does that make
Interesting. Interesting.
I told you it was the advanced portion of the
That
presentation.
is advanced. And this is the reason why you call before.
Yes.
You sell.
This is why you sit down and you strategize.
Yes.
We have a client now who's moved to Charleston under the same pretense.
Yeah. Yeah.
The whole concept of, man, that's appreciated a lot. I love Charleston, so we're moving to Charleston. And you can listen to our podcast on moving to a new state and what you need to do before you get there, because that's very important, that your bank statements and your car and your driver's license, everything gets changed to that new location.
Yeah.
Because you need to actually have moved there. This is not a show about how to cheat the government.
Right. Yes. No.
Let's be very clear. We're
Trying to do right
we're,
here.
We're all inside. There's no gray area here. We're all inside it's all black and white. It's all black and white. All right. So yeah, but you could, the last half of that, it's the same thing with your primary residence. Now you would get excluded, but anyway, from your primary residence up to $500,000 in gains.
Right.
But if you had greater gains than that, you could always turn it into a rental, move out, and then you could do a 1031 exchange for a new property. Now you're now in investment property land. It's hard to leave that.
Right.
Which I guess we can talk about that for a second. I mean, you keep deferring the tax, and at some point that tax has to get paid, right?
Right.
Correct.
Unless you're dead.
You're
Right.
dead.
Yeah, that's one way to get out of it, because tax doesn't carry on to the next generation. So, and plus you get a step up in basis upon death right now.
Yes.
So if you die, you paid $2 million for the property, did all these 1031 exchanges, you have $6 million in gain floating out there you got to pay tax on. But when the new beneficiaries, or when the beneficiaries take over your property, assuming kids, right, then their cost basis gets jumped up to $8 million.
Right.
So it's like they paid $8 million for the house.
Right.
So if they liquidated it, they wouldn't pay any tax.
Correct.
Now, obviously, if your net worth gets high enough, there is some death tax, but it's like nearly $22 million right now, so we don't have to worry about that too much.
Right.
So,
But
yeah.
that's a great strategy if you
never
want to
paid-
leave that legacy for
Yep.
your
Absolute-
beneficiaries.
Yeah.
Do it through that process, opposed to leaving them a bank account or something like that, right?
Right. Well, there's bank accounts don't grow, but
Okay, well.
real estates do.
Yeah.
Real estate accounts do, or should, if you're doing it right. Okay. Well, I mean, what else are we missing?
Call your CPA first.
Yeah.
Yes.
If
Call
you
your
take anything
financial
away,
planner.
call your financial advisor, CPA,
Yeah.
your realtor first.
Yeah, the only thing that I would add to that is prior to the show, we were kind of talking real quick. Right now, in our environment, and as fast as we're seeing appreciations escalate, is a great time to really consider your 1031 exchanges. So I was using an example that most investors would hold on to a property 5 or 6 years before they built up enough equity to be able to do the 1031 exchange and trade up. Now we're seeing 1 year, right? We saw appreciation of 15 to 17%. Now we're seeing an escalation of, hey, it's time. It's time. You hold on to a property 1 year. Let's take out the equity and let's keep on trading up. So that's that's an interesting caveat that we have going on in this market right now. And I would think, Jordan, that you would see an escalation of 1031 exchanges coming across your desk.
Oh, absolutely.
Yeah.
Yeah, it's a different strategy now. I mean, we were talking about this before. In the past, I felt like to be successful at real estate investment properties, you'd buy a bunch of $80,000 properties and you're getting $800 to $1,200 a month cash flow. So you think about yield. I put in $80,000 and I'm getting $20,000 a year. That's a pretty good deal, right?
Yeah.
Or maybe it's less than that. Maybe it's $15,000. That's still, even if it was $10,000, that's really a really good deal. It's going to pay for itself very, very quickly. But you can't find an $80,000 house. You can't hardly find an $80,000 lot.
Yeah.
So at this point, it seems like the game's changed a little bit, where it's appreciation, or you're buying just extremely distressed properties that need a lot of love, and then you're getting them to the market rate, which is a lot higher. So it's capital appreciation seems to be the name of the game, not so much about the yield and the passive
And the
income.
cash flow.
Yeah.
Yes. Yeah. And we were talking a little bit about that earlier as well. And that game has changed lately. And historically, we always looked at cash flow.
Yeah.
You're going to buy a property. How much is this going to yield me every single month? What's my positive cash
They call
flow?
it passive income, right? That's
Yes.
what all the seminars are about.
Yeah.
Generate passive income.
Passive income. Yes.
You're still generating the same passive income, but rental rates can only go up so high because people rent for a reason.
Mm-hmm.
Otherwise, you would just buy a home.
Yeah.
So you can't. If I'm renting a house and it's a single family home, is what, $2,500 a month? I think it's kind of the average.
Yeah. That would be
somewhere
a
in there.
nice one. Yeah.
But what happens, with inflation? Is that ever a $5,000 a month rental? I don't think so.
Well, rental rates are going up faster than appreciation right now.
Okay.
So they're going up.
But there's a period where people who are renting can't afford that rent.
No, you're talking about diminishing returns?
Yes.
Yeah.
There's
you
less
do.
people. There's
I mean,
less people.
Yeah. I mean, there's always going to be a cap on everything. That's true with appreciation as well. I mean, you're going to
What
get
people
to a
are willing to
point
pay for
where,
something.
Yeah. You get that gap in between what incomes are going up and what
Yeah.
payments are.
Well,
and you get
incomes
that
are
gap.
rising. That's what's creating, well, partially what's creating the inflation that we have over the last year is
Yeah.
people are getting paid more. So, yeah.
So incomes are going up, rates are going to go, values are going up, rental rates are going up. So, but to get back to
What
the
do you
original
do on your
point-
properties? Do you have a standard increase each year?
I do. I build in our leases. We have an escalation clause.
So every year
Or,
goes
yeah,
up by
or-
X
or
amount.
a bump. Yep. Now, when it's way below, this is the challenge of managing your own properties. It's well below what the market
rate
increases. Oh, yeah. I mean, my renters right now that have been in, I've got one renter that's been in 2 years. I mean, he's paying way below market rent, which is fine. He's a great renter. Don't get me wrong.
Yeah, the holes in the walls. That's worth something.
Absolutely. But he's paying well below market value.
The only way to really reset that is wait till they move out, or
Yep. Don't
force them out by saying, "Hey,
don't renew the lease."
Yeah.
And go back to them and say, "Listen, we're going to have to sign a new lease at the end of your term,
Okay.
and we're going to have to renegotiate rates."
So maybe there is more upside to the passive income than I'm seeing.
There is. The challenge is it's so competitive out there, and we've seen values appreciate so quickly that finding those properties that have that yield that we typically would want to see in historical markets is very difficult to find.
Okay.
Very difficult.
Because the values have gone up so fast, the rents can't keep.
Yes.
There's no way the rents can
There's
keep
not
up.
a lot of inventory, so it's competitive. The investors out there are all competing against each other.
Well, you're competing against national companies now.
Now you've got these huge institutions that are buying.
Yeah, they own thousands and thousands of homes
Because they
Just in
see
Atlanta.
where rents are going. They see it.
Yeah,
So
yeah, they probably did 20 years ago when this all started. Honestly,
yeah, they did. So they see that, so that you're competing with them. So what most investors are looking at right now is what kind of an appreciation am I going to be seeing over the next couple of years? And the cash flows they'll catch up. It may take 2 or 3 years for a property to really be a cash flow positive.
Yeah.
But they're willing to, feed that thing for the first 1 or 2 years.
institutions probably do that better than individuals.
They got a lot more cash.
Well, not only that, but they're willing to. It's just a spreadsheet. I think a lot of it's like individual stocks. We're talking about this in our last podcast that people get emotionally attached, right?
Mm-hmm.
And so it's hard for them to take that tax loss harvesting because the sell a loser is just very personal. Where increasing that rent rate is very but I like them. They're good. They're good people. I don't want to increase their rate.
Yeah.
So that'd be an interesting study. Individual property management versus more corporate.
Yeah.
Corporate's a lot colder, I would assume.
Yeah. They just look at the numbers.
Yeah.
There's not an emotional attachment for them.
So what I've learned from you today, Tom, is rentals are participating, obviously, in the upward movement of the market, but the monthly rates, the leases, it's going to take a couple years to be able to catch up. It'd be catch up a lot faster if it plateaus, but I don't know. It's hard. Let me ask you this. It seems to me, this is just me driving around town, I don't have any data on this, that the $1.5 to $2 million home is still hasn't moved much. It's up, but nothing like the $300,000 house is now $500,000.
That's right.
And what's the cap for mortgages right now in this area? Is it like $544,000 is the max mortgage you can take before it turns into jumbo?
Well, they just raised it, and I'd have to call my lender friends.
Okay,
I can't remember.
But
what
it's in
it
that
jumped up
$500,000 to
to.
$600,000 range.
They keep bumping it up. It keeps going higher and higher, and I can't remember exactly where it's at.
That's a big cutoff for a lot of people.
Yeah. You stay below that jumbo, and you're absolutely right. The appreciation that we've seen, or the value increase that we've seen in that below jumbo loan price point, has gone way up. Just because you have so many, you've got more demand for those properties.
Yeah.
Right? So it's supply and demand. You don't have as much supply for a variety of reasons, and then you've got a lot of demand. So those prices just keep going up.
I see $3 million houses sitting out there for a long time.
Sure. Yeah, that high end, historically, the days on market have decreased drastically over the last couple of years. However, it's still out there. I mean, you can anticipate a multi-million-dollar house sitting out there for a couple months at least.
Yeah.
On average.
Okay.
Whereas if I've got a $350,000 house in
That's
Woodstock or Marietta that's clean and good, it's gone in hours.
That's crazy.
Not even days. We're counting hours. It's crazy.
Yeah, and those are people actually living or buying the home, not investors necessarily.
Yeah, no.
So what's the key? I mean, if you want to start doing rental properties and call up Jordan and say, hey, I got this 1031 exchange, is it boots on the ground? Is it networking? I mean, how are you getting? You're not just looking at Zillow anymore.
Yeah, no. If it's on MLS, it's too late. I'm not saying there's no deals out there.
Yeah.
But yeah, if it's out on the Zillows of the world, if it's out there and on the open market, you're competing against the world.
Yeah.
So yes, the answer to your question is it's networking, it's boots on the ground, partner up with a realtor.
Do you know one of those?
Yeah, I got one of those.
So we can call you and say, hey, I'm looking for rental properties. This is my sweet spot.
Sure.
And then.
Yeah, we call it a buy box.
Does it have to, still have to go through MLS technically?
No.
So it can just be a private deal?
It can be a private deal.
Okay.
Absolutely.
That's good to know.
That's how I find mine is I'll usually have someone contact me or I'll reach out to someone and they're like, I need an easy, quick way to get out of here. I don't want to go to market with it. I'm just looking for X. And I'll run my numbers and say, all right, I think I can make this work and we'll buy it directly without having to market it or anything.
All right. Well, that was fun.
Yeah.
That was great.
I always like talking to Tom.
I always enjoy this. It's great.
Well, we look forward to listening to your podcast in 2022. Let us know how we can help with that.
Absolutely. I'll be in contact with you.
All right, guys. Great conversation. Talk to you next time.
Thank you.
Thanks for listening to the Wiser Roundtable podcast. We hope you enjoyed it. Make sure to subscribe wherever you're listening. That way you don't miss out on new episodes. Head to wiserinvestor.com and reach out if you have any questions. We would love to hear from you. Today's episode was produced and edited by Lilton Moore. Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and unless otherwise stated are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.